we're going to talk about how to handle common stock when you issue it, when you buy it back, how dividends impact equity, and how profit impact equity. Some of this is a little bit of a review, but we're adding extra details that are new. So let's take a look. At the beginning of the course, if owners gave us cash, this is how we recorded it. Here's our equation, assets equal liabilities plus equity. And we knew that in equity there was contributed capital and retained earnings. And when owners gave us cash, we recorded cash, and we recorded that we got contributions from owners. In this chapter, we're going to learn a little bit more about how to record the cash that we got from owners when it's a corporation. When it's a corporation, we have special requirements. We have to split out the contribution between two accounts, the stock account and the paid-in capital in excess of par account. This is a statutory requirement. I'm not sure that it's got a ton of logic behind it. It's got a little bit of history, but basically you have to split the proceeds, the cash that you got, and you have to put par value in the par account and anything above par in the excess of par account. So in this case, we issued 10,000 shares of common stock. It had a par value of 10. We got 18 for it, but we have to put $10 a share here. And the excess over 10, $8 a share, we have to put it in the paid-in capital in excess of par account. And that's what that account is there. So now when you issue stock, you have to split it between par and excess of par. And you're not allowed to issue stock below par. That's a legal requirement. It's supposed to protect creditors, but most of the corporations just make par really tiny, like a penny or 5 cents, and so it doesn't offer much protection anymore, but originally it was thought to do so. Another thing that's new in this chapter is the possibility that a corporation may buy back its own stock from a prior owner. That is the reverse of this transaction, where you get cash and you issue stock. The reverse is where you give up cash and you get some stock back. The convention when you rebuy your own stock is not to cancel this or reduce this, but to set up a contra equity account called treasury stock. Let's look at that. So now the equity account got a little bit bigger. Now we have this contra account. It reduces equity. So when we bought back 10 shares of common for $22,000 a share, we wrote a check. So now we have a contra account. Notice that that's a minus there. A contra account treasury stock. This reduces equity, and of course we had to write a check in order to get those 10 shares back. So contributed capital is actually the net of these two accounts less that. But treasury stock is always presented at the very end of the equity section as a separate account. The next two things they tell you about impact retained earnings. They earn money for the year and they pay dividends. So we can also add that to our accounting equation. So now we see earnings increasing retained earnings and dividends decreasing retained earnings. So now we have ending balances in these equity accounts, and we can present the equity section of the balance sheet in good form. Let's see what that looks like. The equity section of the balance sheet, if it had any preferred shares, would start with the preferred shares. We don't have any preferred shares here. We've got common stock. It would indicate the par value. If there was no par, it would have a stated value. Or it would say no par, but most of the time there's a par. It would indicate how many shares had been issued, and then it would give you some kind of dollar amount. So the dollar amount for this particular scenario was 10,000, and we issued 1,000 shares. So it would be shown like that. Then the amount above par would be in this next account, and so the total contributed capital would be these two amounts. Notice how we don't put treasury in with this collection. Retained earnings is this new amount that was updated. the earnings less the part that weren't retained, the part that was returned to owners. Now we put in the treasury stock, and it reduces equity. And we indicate how many shares, so there were 10, and they were at $22 a piece. And then we can get total equity. And so that's our equity section in good form.